They taught you risk management so they could manage your risk. Sounds responsible, doesn't it? Like a piece of wisdom handed down to protect you from yourself. Never risk more than 2%. Always use a stop loss. Stick to your plan. It sounds like discipline, but what if it's design? What if the rules you've been trained to follow are the exact levers used to control your behavior? Because in trading, the biggest illusion isn't greed, it's safety. And risk management, the concept built to save you, might just be the system's most effective psychological leash. Think about it. Every trader from day one is told that risk management is sacred, that the key to survival is to protect your capital. You learn to cut losses quickly, to place stops where it makes sense, to size your positions modestly. But the question nobody asks is, who benefits when you play safe? Who profits when you exit early, cut your winners short, and obey the same predictable rules as everyone else? The market isn't chaos, it's choreography. And risk management is the rhythm that keeps retail traders in sync, moving together, reacting together, losing together. You've heard it 1,000 times. Control your emotions. But emotions aren't the problem. Predictability is. Every stop loss you place isn't just a line of protection. It's a signal, a map of your pain tolerance. And that data, it's gold. Because the institutions, the so-called smart money, don't need to guess where you'll fold. They already know. You told them. When you follow the same risk rules that every book, every guru, every trading course teaches, you create patterns, measurable, harvestable patterns. That perfect stop-loss zone below the swing low? That's not safety. That's liquidity. The system knows exactly how far fear extends before it turns into surrender. So it pushes price right to that threshold, not to destroy you, but to measure you. And what do you do next? You repeat the cycle. You adjust your stop a little wider, promise to be smarter next time, and in doing so, give the system new data about your breaking point. That's the genius of control. It doesn't come from dominance, but from compliance. You don't have to be forced to lose. You just have to be trained to play by their rules. Let's be brutally honest. Risk management isn't about protecting your capital. It's about protecting their liquidity. Because your capital is their liquidity. Your stop loss is their entry. Your fear is their confirmation. You were taught to fear loss more than to understand it. Cut losses quickly. Don't let emotions control you. These lines sound noble, but they serve the same purpose: conditioning. You're being trained not to think in probabilities, but in reflexes. You see a red candle near your stop. Your pulse quickens. You see a sudden wick. Your brain screams, exit before it's too late. You move predictably because your training told you safety is priority, not awareness. But the truth is, the market thrives on your safety behavior. Every time you act out of fear, even disciplined fear, your reaction adds liquidity to the system. The stop hunt isn't random. It's engineered through aggregated behavioral data collected from millions of traders, all following the same safe playbook. And the irony? That playbook didn't come from institutions warning you not to lose. It came from them teaching you how to lose, efficiently, sustainably, and repeatedly. Imagine this. If everyone places stops 1% below structure and everyone sizes their trades to risk 2% per trade, what does the market become? A machine built on uniform, predictable liquidation zones. Every bounce, every fake breakout, every stop hunt is just smart money harvesting risk management. They don't need to chase greed anymore. They harvest discipline. Because once everyone becomes disciplined in the same way, discipline itself becomes exploitable. You're told to never over-leverage, but the market needs volume. You're told to set tight stops, but the market needs liquidity. You're told to avoid revenge trading, but the market needs emotional data. Every rule you follow adds one more layer to their behavioral model of you. They taught you risk management, not to make you safe, but to make you consistent. And consistency, in behavior, in decision, in emotion, makes you predictable. Predictability makes you manageable. See the pattern? When you win, you do so cautiously. When you lose, you do so completely. That's the business of retail trading. Not just to take your money once, but to train you to surrender it systematically, under the illusion of professionalism. Let's go deeper. Every broker, every platform, every course that preaches risk management collects data. How often you hit your stop, how fast you close your trades, what lot size you use after a win or a loss. That data is algorithmic fuel. shaping liquidity maps, stop clusters, volatility pockets. You think you're following best practices, but you're feeding the machine that learns how to exploit you. When the market spikes against your stop loss by 1 pip, that's not manipulation. That's calibration. They've analyzed millions of traders who all learned the same safe strategy. So now the system knows exactly how far to stretch your confidence before it snaps. That's why markets feel like they know you, because they do. You've probably noticed, whenever you break your rules, widen your stop, double your size, ignore your risk plan, the market suddenly goes in your favor. And when you stay disciplined, it stops you out perfectly. That's not coincidence. That's reinforcement. You're being trained through pain and reward to believe that discipline equals safety, even when it guarantees controlled loss. The system doesn't want reckless gamblers. It wants consistent liquidity providers. It wants you steady, contained, predictable, playing within the sandbox of their algorithmic design. Every mentor you follow preaches the same message. Protect your capital, risk small, live to trade another day. Sounds empowering, right? But let's decode that. What it really means is lose slowly, predictably, sustainably. Because fast blowups are hard to model, but slow bleeding can be monetized indefinitely. It's the illusion of control that keeps you trapped. You think your stop loss gives you freedom. You think your 2% rule gives you longevity, but all it gives you is predictable surrender. Because true control doesn't come from managing risk, it comes from managing reaction. And that's the one thing they never teach you. They teach you where to place your stop, not how to handle the panic when price approaches it. They teach you to measure loss, not to understand why you feel the need to avoid it. The market doesn't care about your 2% rule, but it knows exactly how you'll behave because of it. Let's expose one more layer. The brokers. They love risk management. They need you to use stop losses, because every time you use a stop, you become a trigger point in their book. It creates predictable flow, liquidity they can hedge, balance, or mirror. Even in non-dealing desk environment, your behavior feeds the aggregate flow that shapes the market microstructure. The illusion of independence hides the reality of integration. Your stop isn't an escape. It's an invitation. And the deeper truth? Smart money doesn't manage risk the way you do. They manage exposure. They diversify across instruments, hedge through correlated assets, and adjust through time decay. Their stop loss isn't a price, it's a plan. But for you, it's a number, and numbers are easy to target. So while you calculate position size on spreadsheets, they calculate emotional volatility, yours. They know that after 3 small losses, you'll break pattern. You'll overtrade, overleverage, or freeze. That's when they strike, because the market doesn't need to take your money. It just needs to make you move it. You're not fighting institutions, you're feeding them. You think you're being careful, but you're being harvested. Your discipline is data. Your data is strategy. And the worst part? You've been convinced it's your fault, that every loss was due to impatience, poor psychology, or lack of control. But the system was built to make you believe that, because guilt keeps you learning, and learning keeps you losing, politely. So what's the way out? It's not to abandon risk management, it's to reclaim it, to stop managing numbers and start managing awareness, to understand that risk isn't just about capital, it's about control. When you decide how much you're willing to lose emotionally, not just financially, you take back power. Stop placing stops where the textbooks tell you to. Place them where your mind is comfortable, where manipulation can't reach. Stop trading to survive. Trade to observe. Stop trying to control outcomes. Control your state. Because the moment you stop reacting to the market's rhythm, you step out of the system's simulation. You stop being managed. Every rule you were taught, every number, every stop, every risk limit was meant to shape your behavior. But once you see that, you can rewrite the code. You can turn your discipline into unpredictability, your safety into strategy, your awareness into freedom. Risk management was never about safety. It was about containment. And the traders who break free aren't the ones who risk more. They're the ones who risk differently. So the next time someone says, protect your capital, ask yourself, from whom? Because in this game, the greatest risk isn't losing money. It's losing control of your own behavior. If this changed how you see risk management, don't just move on. Hit like, share this video with a trader who still thinks safety is salvation, and subscribe to Profit Pulse. In the next episode, we'll expose how market psychology turns caution into currency and why the safest traders are the easiest to control. Stay sharp, stay aware, and remember, what they taught you to manage was never your risk. It was theirs.